Hello everybody, my name is Ty Bernicke and I'm going to talk to you today about how to pay income taxes in retirement. And this is a question that we get quite a bit because when people retire and they're getting these different sources of income, you have to make sure you're paying your taxes to avoid potential penalties. And there's two common ways that we work with clients to help them pay taxes in retirement. And the first way is what we call the withholding method. The second way is something we call the quarterly estimate method. And before I go over those two methods, I just wanted to talk about some of the more common types of income that people have in retirement. And some people will have pensions where they get a monthly income stream. And of course, generally speaking, those pensions are fully subject to federal income tax. Distributions from IRAs, 401ks, and other tax-deferred accounts as you withdraw income from those investments in retirement, you also have to pay tax. Social Security, up to 85% of Social Security can be subject to taxation, and that depends on the level of income. But if you have a moderate to high income, chances are a good portion of your Social Security is going to be subject to income tax. Distributions from taxable accounts are a little bit trickier. So when I say taxable account, if you have a brokerage account or even a bank account, when you invest into a brokerage account, if you invest $100,000 and buy a variety of stocks and mutual funds, that $100,000 you originally invested, when you take it out, it's not going to be subject to tax. But if you're earning dividends or if you have capital gains, that may be subject to tax based on your level of income. You might be able to earn dividends and capital gains tax-free if you're in a lower income tax bracket, but many people will have to pay taxes on dividends and capital gains. And interest income from things like treasury bonds or corporate bonds are also subject to tax when they're held in a taxable account, which again is not an IRA, not a Roth IRA, not a retirement account, just a after-tax investment. Qualified distributions from Roth IRAs are not subject to taxation. So with the withholding method, if you have a monthly pension coming in, most pension custodians will allow you to withhold a certain percentage from that monthly income, similar to your working years when you're having money withheld from your paycheck if you were an employee of an employer. With Social Security will allow you to withhold anywhere from 7%, 10%, 12%, or 22% from your monthly payments. And if you have an IRA account, most IRA custodians will also allow you to withhold taxes from any distributions that you take. And usually it's an elective. Every time you take a distribution, you can elect to have a certain percentage of those IRA distributions withheld. Withholding money from taxable accounts, as I had just mentioned, that's actually not allowed with most custodians. So as you earn dividends and interest income, and if you have capital gains, unfortunately, you can't do withholding from those types of accounts typically. And distributions from Roth IRAs, again, usually those aren't subject to tax and therefore do not allow for withholding. So how much do you have to withhold to avoid paying a penalty? Unless you owe less than $1,000 for taxes, you will have to pay in the lesser of the two amounts that I'm going to go over right now. You have to pay in at least 100% of the tax shown on your tax return from the previous year. It could be as high as 110% if you are a high income earner. If you're not a high income earner, it's 100% of what you paid previously. For the previous year, you have to pay in the current year. Or at least 90% of the tax owed for the current year, which you would obviously have to make a projection on that to determine which of those two amounts is the lower out of the two. So that's in a nutshell how the withholding method works. Many of our clients only will use the withholding method. A lot of our upper income clients will not get by on the withholding method alone. So many of them will use what's called the quarterly estimate method. And with the quarterly estimate method, you basically have to pay in taxes to the federal government, and depending on the state you reside, potentially your state government too. And you usually have to do that 4 times a year based on a predetermined date. set by the IRS. As far as how much you have to pay in, again, this is either the lesser of 100% of the tax shown on your tax return for the prior year, or up to 110% if you're a high earner, or at least 90% of the tax owed for the current year. Some people can do a combination of the withholding method and the quarterly estimate method, and some people can just do one or the other, depending on your unique circumstances. If you have any questions on this, or you'd like to schedule a quick 15-minute call, you can click the link on the description or visit our website at www.bernicke.com. Thank you.